looks like we have the majority of people who are going to show up today. So thank you everyone for joining us. So just a few brief introductions before we get started. Lesley Hargraves is on with me, and she is an audit partner with me as well. And she will be doing most of the talking, and then I will follow up at the end and talk about inventory. And so she's been with our firm for a lot of years and started at EMY. I was with PwC prior to this, and she works primarily on tech clients, and I am primarily manufacturing all things inventory. So hopefully we can answer all of your questions that come through. Hopefully, if we can't, we will definitely follow up at the end, or let your audit teams follow up with you. So we'll be gathering questions and send them along, and we'll get started. Go for it.
Thank you, Sarah. Thank you. All right, let's get started. Thanks for joining us virtually. Hopefully next year we can all do this in person again, but we're glad that you're able to join us virtually this year. We will get started. So 2020 has certainly been a very unusual year, and companies are going to need to consider whether they face any accounting or financial statement disclosure implications resulting from the COVID pandemic and its economic fallout. Sarah, I think maybe if you want to click your mute button, that'll help a little bit too.
I will do that. And to remind everyone to use the Q&A function as we're going through the presentation, and we will gather everything as we go.
Perfect. So our goal in the time that we have today is to provide you with an overview of some of those considerations. Certainly there are more ways that the pandemic may affect your financial statements, but today's conversation should be a pretty good starting point. We're going to talk about going concern considerations. We'll provide an overview of the guidance for impairment of long-lived assets, then learn a little about exit and disposal cost obligations, and the accounting options for the forgiveness of PPP loans. We will also consider some of the potential impacts to revenue recognition under the new guidance in ASC 606. And then lastly, Sarah's going to help us talk a little bit about inventory overhead allocation. So as Sarah mentioned, we will make time for questions, but just be sure you use that Q&A feature to submit your questions. That's just easier for us to track than if you use the chat box. There should be a button on your screen that says Q&A, so just use that function. And then if you have a question after today's event, just feel free to reach out to either Sara or myself or any member of your audit or tax team at Maxwell Locke Ritter, and we will be happy to try and help. All right, so let's get started with a discussion of going concern. Before we really talk about the impacts of COVID specifically, let's just talk about an overview of what that US GAAP standard requires. So US GAAP requires management to look at least 1 year past the date the financial statements are available to be issued and consider whether preparing your financial statements on a going concern basis is appropriate. So for example, if you're getting a financial statement audit completed for 2020, management has to look out at least 1 year and evaluate if the company will be able to continue for a going concern. And that 1 year mark is 1 year past the date the financial statements that accompany that audit report are available to be issued. What does that really mean? If your audit report is issued on April 30th of 2021, you're going to need to consider all of the conditions and events to determine the company's ability to continue through at least April 30th of 2022. And your auditor, if you're getting financial statement audits, has a responsibility to evaluate the reasonableness of that evaluation that management makes, including your plans to effectively mitigate any of those conditions and events. Your auditor also has a responsibility to consider the adequacy of the disclosures in your report about the conditions and events that were relative to that going concern. So what happens if you can't show through the use of cash flow forecasts and cash on hand that it appears that the company will survive for that 1 year period without additional uncommitted debt or equity funding or some other type of support? That's when you may see an auditor's report that includes an emphasis of matter paragraph that discusses going concern. You'd also see some additional disclosures in your footnotes that discuss the going concern evaluation and management's plans. And then alternatively, what if that going concern risk exists, but you're able to alleviate it, either maybe through debt or equity fundings subsequent to year end or other remedies? In that case, the auditor's report may not include that going concern paragraph, but you still might need some additional disclosures in your footnotes to discuss the going concern evaluation and how it was alleviated. So this requirement to evaluate going concern exists for companies every year, but the impacts of the pandemic may certainly affect your considerations for 2020 financial statements. So for example, prolonged plant closures, or maybe the inability to collect from your customers whose businesses have been severely affected by the pandemic. Those things may all affect your operating cash flow and liquidity, which means management may need to update the cash flow projections that it's using in its going concern evaluation. Now, of course, depending on the industry that your company operates in, the pandemic really may not create concerns that cause significant doubt about the company's ability to continue for at least that 1 year period. There are certainly companies in the hospitality industry and other industries that have been negatively impacted by COVID, but there are also a lot of businesses that are thriving in this crazy year. So all of that is factored into this going concern analysis each year. I'm going to move on to impairment. And this can be a very complex topic, and it's also one that requires significant management judgment at each step along the way. So we're going to cover an overview here, but I am almost certain that many of you will have specific questions that are related to your own circumstance. And you may want to talk with your audit teams about those in advance of your 2020 audit. In many more normal years, this impairment analysis may not be a big concern for the company. It might be something that your auditor can get fairly comfortable fairly easily during the audit. But as with so many things with the pandemic, this definitely has the potential to impact your analysis around impairment for your 2020 balance sheet. So many companies have experienced a decline in revenues. In some instances, they've even been forced to close temporarily. Some manufacturers have said they expect supply chain disruptions, or maybe temporary business closures in affected regions. All of that would limit your ability to meet demand for products. All of those factors and more could be indicators of impairment, depending on the significance and the duration of that disruption. While short-term disruptions may not indicate an impairment, the effects of a longer-term disruption could certainly cause asset impairments. So under US GAAP, the important thing here is there is a specific order you have to follow when performing asset impairment tests. You'll see that order mentioned on this slide here. It's important because any impairment losses that get recorded at any step along the way have to be recorded before you move on to the next step. And that's because the impairments that you may need to record would could impact fair value. You need that for impairment testing. So you have to go through these literally in this 1, 2, 3 order if you have all of these items on your balance sheet. So if you have indefinite lived intangible assets on your balance sheet, those have to be tested for impairment first. You test those at least annually, and then more frequently if impairment indicators exist. And any necessary impairment losses from that analysis all get recorded to your GL before you move on to step 2 that you see here, which is to consider the impairment guidance for long-lived assets to be held and used. So those are your assets like property and equipment and amortizable intangible assets. The impairment test for those only needs to be completed when, when impairment indicators exist. So again, you'd record any necessary losses to your GL before you move on to this last step in the chart, and that's to consider the impairment guidance for goodwill. Once you get to goodwill, you have 2 options there for your impairment analysis, and that's because some companies may have elected to take the private company approach for goodwill, and they're amortizing goodwill, and other companies are not. Others are not amortizing goodwill and have not taken that private company election. For those that have not taken the private company election, you're looking at your goodwill impairment test at least annually, and more frequently if you have impairment indicators. And if you have taken that private company election and you're amortizing goodwill, you're only required to complete the impairment test when impairment indicators exist. So we're going to spend some time on the next few slides going over an overview of the considerations related to each of these impairment tests. But remember, not all of these steps may apply to you. Many companies don't report indefinite lived intangible assets or goodwill on their balance sheets, which would mean in this chart you're seeing here, only step 2 would apply for your purposes. We'll start with step 1, so indefinite lived intangible assets. Those have to be tested first. So again, we're going to test those at least annually. This is also when you're considering potential impairment on any other assets subject to impairment testing. So inventory, receivables, equity method investments, those accounts all have their own guidance about how you consider impairment, but that's all happening at the same time when you begin your impairment analysis. Any necessary impairment losses that result from this analysis for indefinite lived intangibles or anything that needs to be reported for other receivables, inventory, etc., any of those losses would need to be reported to your GL before you keep moving on in the order of impairment testing that we looked at on the last slide. So with the indefinite lived intangible assets, you start off from the very beginning, you have a choice to make. So you can choose to either first assess qualitative factors to determine whether the quantitative test is required, but you also have the option to just say, I'm going to bypass that qualitative test and go straight to the quantitative test. If you choose to do that qualitative test first, let's talk a little bit about what that means. You'll consider many factors. You're going to look at industry and market conditions, cost factors, financial performance, changes in management or key personnel, just a long list of qualitative factors that you need to consider. There's certainly significant management judgment involved at each step in that process. But if management determines that the company doesn't have any negative events or circumstances that indicate impairment as a result of that qualitative test, or if they go through that test and determine that after assessing all of the events and circumstances, there isn't a greater than 50% likelihood that there was an impairment, then a quantitative test is not required. You're done with the indefinite lived intangibles portion. But keep in mind, if you're getting annual financial statement audits, your auditor would still need to get comfortable with your conclusions on why the qualitative test indicated you didn't need to go any further. But if you go through that qualitative test, or if you elect to skip just straight to the quantitative test, the first thing you're going to have to do with the quantitative test is to define units of accounting. So that is another area that requires significant management judgment. It's also one that many of us probably don't have a lot of experience with. And so what does that really mean? We're going to talk about the guidance here and then hopefully give an example that makes it a little more clear. But again, you can always reach out if you have questions specific to your circumstance. The guidance gives us some rules about what you can and cannot include in a unit of accounting. So first, it can only include indefinite lived intangibles. You cannot test those assets in combination with goodwill or any of your amortizable intangible assets. That unit of accounting can't represent a group of intangibles that collectively constitute a business or a nonprofit activity, but it can include indefinite lived intangibles that are recorded in separate financial statements of consolidated subsidiaries. And that will show up in our example in a minute. But how do you really know if you have multiple indefinite lived intangible assets that you need to combine into one unit of accounting? Separately recognized indefinite lived intangibles should be combined for impairment analysis if they operate as a single asset. So if they are essentially inseparable from one another. And there are some indicators that you might need to combine those. If they were purchased in order to construct or maybe enhance one single asset, so they're going to be used together, or if you had acquired the intangibles in the same acquisition, would you have recorded them as one asset? Or if your intangible assets as a group represent the highest and best use of the assets. So that seems really foreign if you haven't heard that term before. And it's effectively just saying, that might be true if it's unlikely that you would sell a substantial portion of those assets separately. Or if you did sell a substantial portion of the assets separately, it would result in a significant reduction in the fair value of the remaining assets as a group. And lastly, you can even look to your marketing or branding strategy for indication that the assets are complementary. For example, a trademark and its related trade name and technological expertise might need to be combined into one unit of accounting. And at the same time, the guidance gives you some examples of indicators where you wouldn't need to group indefinite-lived intangible assets into one single unit of accounting. There are a few you can look for. If each of those assets is generating cash flows independent of the other intangible assets, you wouldn't need to group them. So an example here would maybe be if you were licensing an intangible asset to another entity for exclusive use, that might be an indicator that you don't need to combine them. If you were to sell the assets, would you sell them each separately? Is it likely that they would be sold separately? Or if the company is considering a plan or has adopted a plan to dispose of one of those assets or one or more of those assets separately, that could indicate you don't need to group them. Or if the assets are used exclusively by different asset groups. So we'll talk about what an asset group is on the next slides. Just you can keep that in mind and as we move on. And then lastly, there might be factors that limit the economic life of one of the intangible assets, but wouldn't do the same, wouldn't similarly limit the useful economic life of the other intangible assets. That would also indicate you don't need to group them together. So what does all of that really actually mean? Maybe a practical example would help a little bit. So assume that your company buys another company and it has operations around the world. The operations of that acquired entity are conducted through separate legal entities in different countries, and each legal entity owns the registered trademark, or trade name, excuse me, and that's used in each country. So when you recorded the business combination on the acquisition date, you may have recorded 3 separate intangible trade name assets on the 3 separate financial statements of each legal entity, so on each subsidiary. Even though you may have separate identifiable cash flows for each country, and each country may represent a separate asset group, there is one company brand manager responsible for the entire company's trade name. And that trade name relies on worldwide sales of the company's products to be recoverable. So as a result, you determine that the 3 separately recorded trade names really should be combined into one single unit of accounting, excuse me, of accounting for impairment analysis purposes. Okay, so once you've actually defined what your units of accounting are, you have to go on to perform the quantitative test for each of those units. That's going to start with estimating fair value for each unit of accounting. And again, that's going to involve significant management judgment. You might elect to hire a third-party valuation specialist, or you might elect to estimate that fair value on your own. You could use an income approach or other calculations. And remember, if you're getting an annual financial statement audit, your auditor would need to get comfortable with not only how those units of accounting were defined, but also how you estimated fair value for each of those. If your estimated fair value exceeds carrying value, you're done, and no impairment loss on indefinite-lived intangible assets needs to be recorded. But if your carrying value exceeds the estimated fair value that you calculate, then you do need to record an impairment loss, and that has to be done excuse me, before you move on to that second step in the impairment test order. In addition, if there is impairment, management should consider if the asset continues to meet the definition of an indefinite-lived asset, or is that an indication that maybe the remaining asset value should be amortized over the asset's remaining useful life. Hopefully everybody is still awake. We're gonna look back one more time at this slide just to remember our order. We've talked about indefinite-lived intangible assets. So now we're gonna move on to step 2 in that impairment testing order, and that is to test long-lived assets to be held and used for impairment. An important note here, if you have a disposal group that you've held for sale, that is not covered in this guidance, and the order of impairment testing would differ, and that's not what we're focused on today. So just know that if you have some assets that are held for sale. Long-lived assets that are held for use would include land, buildings, equipment, vehicles, and all of your definite-lived intangible assets. So in other words, it's fixed assets and amortizable intangible assets. Because it includes fixed assets, this step of the impairment testing is going to apply to most companies. Most companies end up with some fixed assets on their balance sheet. So testing here for impairment is only required when impairment indicators exist. There's no annual impairment testing requirement. You're looking for triggering events that would indicate that a test is needed, and that can include a lot of factors. You would look for things like a significant decrease in the market price of the long-lived asset, or a significant adverse change in the extent or the manner in which you're using that asset, or in its physical condition, or maybe in the business climate in general. You'd also look at things like the cost to acquire or construct an asset, if those costs are significantly exceeding your original expectations. Look at current period operations or cash flow loss combined with a history of operations or cash flow losses, or maybe even a projection or a forecast showing continuing losses associated with the asset. And then lastly, you might look at a current expectation that there would be a greater than 50% likelihood that you're going to sell or dispose of that significantly before the end of its previously estimated useful life. So if you have any of those triggering events and impairment testing is required, the first thing you have to do is define your asset groups. So similar to defining units of accounting that we looked at on that last slide for indefinite lived intangible assets, there's a lot of judgment involved in defining your asset groups. And it's also a topic that people often aren't very familiar with. Your asset groups actually may include assets and liabilities other than the property and equipment and the definite lived intangible assets that we're talking about looking at for impairment. For example, it might include goodwill or indefinite lived intangibles. Those might need to be included in your asset group, which is also another reason why it's important that you follow the order of impairment testing we've looked at a couple of times now. If you did need to book an impairment on indefinite lived intangible assets, based on what we talked about earlier, it would be important that you had recorded that impairment before you start now looking at potential impairment on your long-lived assets that are held and used, as that would impact the carrying value of those asset groups. So how do you group your assets, right? So in general, assets are going to be grouped when they're used together to generate joint cash flows. And for purposes of this impairment test, the assets are grouped at the lowest level for which there are identifiable cash flows that are largely independent of the cash flows of the other assets and liabilities. What does that mean, and how do you do that? It's very important here to understand how management views the business in order to make appropriate asset grouping decisions. And sometimes the most appropriate asset grouping might be a business or a reporting unit. For example, some companies may determine that the lowest level that they can identify independent cash flows is at the entity-wide company level. And other companies may determine that maybe that lowest level is at each subsidiary company level. And still other companies may be looking at the business, at the cash flows of the business at significantly lower levels, maybe at a reporting segment level. So understanding how management views the business is essential in order to determine what your appropriate asset groups need to be for this purpose. Once you've defined those asset groups, you then go on to the next step, which is not actually, you don't go straight to fair value. First, you need to test for recoverability for each of those asset groups. And for the recoverability test, management is going to need to put together an estimated undiscounted cash flow analysis for each of the asset groups. So you'll use the estimated remaining useful life of the asset group to determine what period of time you look at for that cash flow analysis. And that remaining useful life is based on whatever the remaining useful life is of the primary asset in that group. So that's your long-lived, amortizable, tangible, or intangible asset in the group that's the most significant asset from which the group is deriving its cash flow generating capacity. So if that is a asset that has a 15-year life, you're going to look at a 15-year cash flow analysis. That's what's going to drive your time period. So management then compares that estimated undiscounted cash flow amount to the carrying value or the net book value of the asset group. And if the estimated undiscounted cash flows exceed the carrying amount of the asset group is recoverable. There's no impairment indicated. And in that case, you're done with the test and you don't have to go on to consider fair value. But if that happens, you should still consider if the existence of those indicators of impairment have any implication on the estimated remaining useful life or maybe the salvage value of the assets. Is there any indication that you might need to reduce either of those things as a result of those impairment indicators? But if your estimated undiscounted cash flows are actually less than the carrying amount of that asset group, you're not done. The asset group is then not recoverable, and you have to keep going on this slide and move on to determine fair value, which is done consistently with what we discussed earlier regarding indefinite-lived intangible assets. You may elect to hire a third-party valuation specialist, or you might elect to estimate that fair value on your own using an income approach or some other calculation. And again, if your estimated fair value exceeds carrying value, you're done and you don't have an impairment loss to record. But if your carrying value exceeds your estimated fair value, you are going to need to record an impairment loss before you move on to that third step in the impairment test order. And you also have to consider how to appropriately allocate that loss to the individual assets in the asset group. So remember, if you grouped a bunch of things together in your asset group for purposes of the test, that impairment loss now needs to get allocated to the appropriate assets, the appropriate amount. That loss allocation is done on a pro rata basis. You use the relative carrying amounts of the assets. And it's important to remember that the loss here is only allocated to the fixed assets and the definite-lived intangibles that are included in your defined asset group. So you've grouped all these assets together for purposes of the test, but at the end of the day, you're still doing an impairment test on the long-lived assets to be held and used. And if there is a loss indicated, that loss has to be allocated to those long-lived assets. If your asset group includes indefinite-lived intangible assets, goodwill, or other assets like inventory or accounts receivable, the impairment loss you're calculating here doesn't get allocated to those assets. Each of those is subject to their own impairment guidance under GAAP, so it doesn't apply here. And then one last note on allocation. If you're allocating a loss to individual assets in the group, any individual asset in the group can't take a loss that would reduce the carrying amount of that individual asset below its fair value. So it may be using that pro rata allocation, you need to make adjustments so that no individual asset gets recorded at an amount less than fair value. A last reminder here, if you are getting audits every year, your auditor, again, has to get comfortable with all the judgment that goes into these calculations and how you define your asset groups and everything else, the estimate of fair value, the allocation. So we'll be talking with you to get our arms around what you've done and what judgments were made. So let's turn back to the slide one last time. We've already talked to these first two steps, but if your balance sheet also includes goodwill, you have to keep going. There's a step 3. Hopefully, I have not lost you yet, and listening to me talk about impairment has not put anyone to sleep. The guidance for impairment testing is complicated. It's very specific, but please just reach out to your audit teams at Maxwell Locke Ritter this year if you have questions. We have gone through this analysis in the world of COVID with several clients with March or later year ends, and in practice, it often isn't as overwhelming as the guidance that we're talking about may make it seem, and we're happy to help as we get ready for the end of year. And then other good news, the next couple of slides on goodwill impairment will be easier to get through because they have a lot of similarities to what we've already talked about. So let's look at goodwill. Getting close to the end of this impairment discussion. And as we mentioned earlier, goodwill impairment analysis, the requirements there vary depending on if you have elected the private company election to amortize goodwill or not. So we're first going to talk about explaining the guidance for those companies that don't elect the private company alternative. So those companies that are not amortizing goodwill on their balance sheets. In that case, like indefinite lived intangible assets that we talked about earlier, you have to test goodwill for impairment at least annually, and then more frequently if there are indicators of impairment. Again, significant management judgment is going to be involved at every step of the process. And the first step is to determine the reporting unit for impairment testing. So a reporting unit is an operating segment, or one level below that, a component. So similar to how we determined asset groups when we talked about fixed assets and definite lived intangibles, understanding how management views the business is really important in understanding what your reporting units are. A component of an operating segment might be a reporting unit if management is regularly reviewing the discrete financial information and operating results of that component to make decisions. Many times, a reporting unit may just be the entity as a whole. This next part should feel familiar. It's similar to what we've already discussed. You have a choice of first going through a qualitative test to determine if there is a greater than 50% chance of impairment. If you conclude that there's greater than 50% chance, or if you elect to skip this qualitative test altogether, you'll need to move on to the quantitative test. And again, that quantitative test is going to require you to estimate fair value of the reporting unit. That's estimated as the price that would be received to sell the reporting unit in an orderly transaction between market participants on your measurement date. You can use a lot of different methods here. You might look at discounted cash flows, EBITDA multiples, whatever the appropriate calculation might be for your particular instance. But if estimated fair value exceeds your carrying value of the reporting unit, there's no impairment indicated and you're done. But again, if your carrying value exceeds the estimated fair value, you have an impairment loss to record to goodwill. And as always, we keep talking about it, but if you're getting audits, just remember that part of that audit process is to get comfortable with all the judgments that are going into each step of this process as well. So if you have taken the private company election and are amortizing goodwill, then your impairment test is different than the one we just discussed. And this slide goes through all the steps for those clients that are, or for those companies that are taking that private company election. The impairment test in that case is only required when you have impairment indicators. And so you're not doing an annual test unless there are impairment indicators. And those companies can elect to perform the impairment test at either the entity level or the reporting unit level. So we already discussed how to determine a reporting unit on the last slide by looking at what level management regularly reviews financial information and operating results. You can elect to perform the test at that level or at the company level. It's either step, either election is appropriate. Just like all the other tests that we've talked about so far, there's a lot of management judgment involved at each step of the process. This next part, once you've decided if you're going to do that test at reporting unit versus entity level, the next part's going to be pretty familiar again. It's what we discussed for indefinite lived intangible assets and the other goodwill test. You have a choice of first going through that qualitative test or skipping straight to the quantitative test. And that quantitative test is going to require you to estimate the fair value of either the reporting unit or the entity, depending on what you elected. And fair value here is consistent with what we discussed before. It's the price that you would receive if you were to sell at an orderly transaction between market participants. If estimated fair value is greater than carrying value, no impairment, you move on. But as always, if your carrying value exceeds your estimated fair value, or if your carrying value is negative, then you have an impairment loss to record. And with that, we have made it. We can finally move on past our discussions of impairment testing. So thank you for hanging in there. The rest of this is hopefully a lot less dense than what we've just spent time talking through. We're going to shift and talk about exit and disposal cost obligations. The economic impacts of the pandemic may result in some companies deciding to sell or abandon certain assets, or they may enact restructuring plans. For example, a company may decide to terminate an office space lease agreement, or they may need to lay off a portion of their workforce. Accounting for all of those activities is covered under Topic 420. One important note here, if you have already adopted the new leasing standard in ASC 842, the lease termination accounting is no longer covered under Topic 420. But in case you haven't heard already, part of the relief that FASB provided during COVID was to further delay the required implementation date for that new lease standard. It now doesn't have to be adopted until 2022 for calendar year-end companies. And the majority of our clients haven't adopted that new lease guidance yet. So we're going to focus today on how to account for lease terminations for companies that are still accounting for leases under the legacy lease guidance. Some exit and disposal costs may just be recorded as incurred. So costs like those incurred to consolidate or close a facility, or security costs that you might incur on a closed facility, or even employee relocation costs. Those are all recorded as incurred. But we're going to spend a bit more time on the next couple of slides talking about how to account for one-time employee involuntary termination benefits and the cost to terminate a contract, because those costs are not recorded as incurred. With the involuntary employee termination benefits, you first have to understand if those benefit payments require your employees to provide future service to the company or not. So if your employees are required to work for an additional period of time beyond a minimum retention period to get their benefits, that means there's a future service requirement. But what is a minimum retention period? In some cases, companies might be required by law to provide some advance notice to employees regarding termination, or a company may just choose to let their employees know a short time in advance of their actual termination date. So what does the guidance say? It effectively says that the minimum retention period can't exceed the legally required notification period. And if there is no legal notification requirement, that minimum retention period can't be longer than 60 days. So that's what you use to decide whether or not you're requiring your employees to provide future service or not. You're going to see communication date mentioned a couple of times here, and so it's important to also understand what that communication date is. So that's going to be the date that management has committed to a detailed written plan of termination that has all the necessary approvals, and that plan has been communicated to the employees. The details have to include specifics, so the number of employees, the job functions, the expected completion date, all of those type of details need to be included. And it also needs to establish the specific terms of the benefit arrangement that your employees will receive upon termination. And then lastly, it needs to be unlikely that significant changes to the plan will be made or that the plan will be withdrawn. So both when you have a future service requirement for employees and when you don't, you're going to need to measure the fair value of the liability associated with those one-time employee involuntary termination benefits on the communication date. What kind of benefits could be included as one-time termination benefits? So a few examples, things like obviously severance payments. Also, if you're going to provide outplacement job training or maybe counseling services, those benefits would all qualify in this calculation. If there is no future service required beyond that minimum retention period in order to get the termination benefits, you'd record that liability for the benefits at fair value on the communication date. Given that your minimum retention period is likely very short, maybe a month or two or even less, going through the present value calculations here, it likely wouldn't make a material difference. But technically, you'd record the present value of the cost of the one-time termination benefits you're providing as an expense and a liability on the communication date. So what happens when you do require future service beyond that minimum retention period? An example here might be communicating the plan to your employees on the communication date, but requiring them to continue working over the next 6 months until you close a certain location in order to get their benefits. When future service is required to get those termination benefits, you still measure the fair value using a present value calculation on the communication date. And depending on what that required service period is, the impact of present valuing the liability might be more material. In this case, it still may not be if it's still a relatively short period of time. And once you've determined that fair value, you're then going to have to recognize the expense ratably over the required service period. So now what do you do if that plan of termination changes? And remember, in order to record that liability on the very onset, it needs to be unlikely that there's going to be a change made to the plan. But sometimes things change, especially in the world of COVID. So what do you do if that plan of termination changes and employees who are expected to be terminated are retained for a longer period of time than planned, or you have to make some other change to the plan? In those instances, you're going to update your estimate of the fair value of that liability to reflect the change when you know about it. And the true up is going to impact your P&L in that same period. So it's like changing any other estimate. When you know better, you true up the estimate and you do a catch up to your P&L to get it to the appropriate amount. The other piece of exit and disposal costs that we want to talk about is cost to terminate a contract. So this applies to the costs associated with terminating either an operating lease or maybe any other service contract, maybe a penalty that you have to cancel a service contract. The pandemic has resulted in some companies deciding to abandon their office space or terminate other service agreements that they may have in place. And the guidance under Topic 420 addresses all of that accounting. But remember, it does not apply to leases under the new lease standard under Topic 842, and it also doesn't apply to capital leases. Those have their own guidance as well. So let's first talk about how to account for terminating a contract before the end of the contract term. So this could happen if you have an early termination clause in an operating lease agreement or a penalty clause for early termination in a service contract. Once you communicate that decision to terminate the contract to the counterparty, you have to record the liability for the costs associated with terminating that contract at fair value. So if you're leasing office space, as an example, and you decide that you no longer need that space prior to the end of the contractual term, and your lessor has provided an option for you to terminate the lease early through a buyout, you need to record the expense and the liability associated with that buyout at fair value at the time you enter that contractual commitment with the lessor to terminate. Similar to what we talked about with employee termination benefits on the last slide, it's very likely that any present value calculation here probably wouldn't be material in the case of these contract terminations. That's just because typically there's not going to be a significant amount of time between when you exercise that contract termination and the payment of the actual fee. So it's unlikely that it would have a material difference. But alternatively, you might just decide to completely abandon your office space before the last day of the lease term, but you can't terminate the lease and you're contractually obligated to keep paying those rent payments. So what do you do in that case? Here, it's really important to know that fully abandoning the space means just that. You cannot be using it at all, not even just as storage space. So this does not apply if all of your employees are working from home like we are, but you still have that office space sitting there full of furniture and other things. And in that instance, you haven't abandoned the space. So you can't, this guidance doesn't apply. The other important note here is that that space has to be separate from any other space you lease. So it has to be capable of being sublet because they could enter the space from a common area. The date you fully abandon that space is what's known as your cease use date. And in that case, you record the expense and the liability at the fair value on that cease use date. When you do your fair value calculations, you need to include any remaining lease payments. You'd also include any CAM payments that you're contractually obligated to make. But this part, I think, often gets overlooked. You would have to reduce that fair value estimate by an estimate of any sublease rentals that could be reasonably obtained, even if you don't necessarily intend to sublease that space or you don't have a tenant in mind, you still have to consider that in your fair value calculations. But there are two exceptions to that. There are two times when you don't have to include that estimate of potential sublease payments. So that would be if your lease agreement prohibits you from subleasing the space, because then you're just not able to do that. Or if maybe your remaining lease term is so short, it's just a few months, and it just wouldn't be reasonable to find a tenant and get them moved in during that short period of time. And so it just doesn't make sense to include that in your calculation. And then lastly, again, technically this would be discounted to present value, the liability would be, but if the length of the remaining lease term is pretty short, that's probably not great material. All right, so it is time for a polling question. Remember, you have to respond to our polling question in order for us to issue your CPE, so please be sure to respond. We're going to talk about this next, but did you know that you have options on how you account for PPP loan forgiveness? If you could respond here and let us know what your plan is, we'll talk a little more about that on the next slide.
And Lesley, since you were talking about terminating leases, we did have a question come through our Q&A, so I thought you could maybe answer it while people are answering the full question. So it says, if you decided to close a legal entity and the end date was March 31st, 2020, but then COVID happened and an employee continued to use the office space because they needed to get out of the house, when would you book the net lease expense? So remaining lease less sublease expense.
Yeah, and in order to book that liability, that space does have to be fully abandoned. So if your plans changed and you're still in that space, you haven't fully abandoned it, and you can't yet take that expense. All right, I'm not sure how long our polling question will stay up, but while that's up there, let's jump to the next slide. All right, here we go. So many of you may, so I'm taking a look at the results. It's interesting how many people don't have a PPP loan, but many of you may have received PPP loans under that CARES Act earlier this year. And as you know, those provide options for forgiveness. So if you meet certain criteria, you can apply for forgiveness instead of repayment of that debt. In June of this year, the AICPA issued guidance on how for-profit business entities and not-for-profit entities can account for that forgiveness under US GAAP. So there really wasn't guidance out there that specifically addressed how to account for government grant assistance when you're a for-profit business entity, which is why they came out with this clarification. So let's talk about what your options are. First, it would always be appropriate for a company to choose to account for those funds that they received under the PPP loans as debt. That's the structure of the loan agreement, and that would be an appropriate presentation on your financial statements. So even if you expect to qualify for forgiveness, you could elect to account for those funds as debt, and in that case, you're going to accrue interest at the 1% interest rate over the term of the agreement until it is forgiven. And because of the guidance in topic 470, you cannot recognize that gain from forgiveness until the SBA formally grants you forgiveness. Once you do have formal forgiveness from the SBA, you'd book a gain at the net carrying value of the loan. So that's going to be the amount of the funds you received plus any accrued interest. And then that amount could also be reduced if you had any debt issuance costs that you might have capitalized. Under that debt model, you continue to recognize your qualified expenses. So the payroll, rent, all of the qualifying expenses under the loan, those continue to be recorded as operating expenses as incurred, just like you normally would under your accounting policies. And when you do ultimately record the debt forgiveness, it gets presented separately on your income statement. So, you know, pros and cons, using the debt model certainly requires less judgment, but it does result in a later P&L recognition associated with the forgiveness. And the process associated with applying for that forgiveness and then receiving that formal approval from the SBA is just going to take time. So it's possible that you won't receive forgiveness prior to the end of 2020, and your 2020 income statement would continue to show your qualifying operating expenses as you would normally record them, and it would show that 1% interest expense associated with the PPP loan. And then your 2020 balance sheet would still show that PPP loan liability and the related accrued interest expense. And it might not be until 2021, when the forgiveness is formally granted, that you get to remove those liabilities from your balance sheet and recognize the associated gain from forgiveness through your P&L. You do have an alternative. If you expect to meet the eligibility criteria for forgiveness and you conclude the PPP loan in substance really represents a grant, you can elect to account for the funds received as a grant. So because US GAAP doesn't specifically address accounting for government grants received by for-profit business entities, you will need to look to guidance available under other standards for some direction. The initial cash inflow is going to be recorded as deferred income. And if you're a for-profit business, you have to wait to begin recording the forgiveness through your P&L until you have reasonable assurance the criteria for forgiveness will be met. What does reasonable assurance mean? So GAAP generally thinks of that as it being at least 75% sure. And if you're a not-for-profit entity, you need to wait to begin recording forgiveness until the conditions of the forgiveness have been substantially met or explicitly waived. So in practice, both of these approaches for the for-profit entities and the not-for-profit entities are going to result in recognition of the income from forgiveness over time as you're recognizing the related qualified expenses. If you're a for-profit business, you have some more options. You can choose to record that forgiveness as other income. Again, that's going to be over time as you're incurring the expenses. It could come through other income, or you could also record it as a reduction of the related qualifying operating expenses. Either choice is appropriate. If you're a not-for-profit entity, you would account for that forgiveness as contribution revenue. So using this grant model is going to require more judgment because you do need to meet that reasonable assurance or substantially met criteria, but it does result in an earlier P&L recognition for forgiveness. So it likely would result in the associated PPP loan liability being removed from your balance sheet prior to year-end 2020, and you'd recognize the P&L impact of forgiveness in 2020 as you also incurred and recognized the related qualifying expenses. Big picture here. If you feel confident that you're going to receive forgiveness, you have the option of choosing from either of these models. The guidance just requires that you fully disclose the accounting treatment that you elected in your financial statements so that it's easy for the reader to understand what you elected and how that impacted your financial statements. I would just say I would discourage you from getting yourself into a situation where you have now recorded forgiveness through your P&L only to later have to reverse it because it isn't actually granted by the SBA. I will say too, though, if you're getting audited financial statements, it's likely that you might have the benefit of hindsight and knowing if forgiveness was granted by the SBA before you actually issue those 2020 audited financial statements. So you do have some time to decide.
And Lesley, we have a question.
Yes.
Someone is asking, can you confirm
Sure.
a not-for-profit organization can record the forgiven PPP as a grant?
Did you say not-for-profit?
Yeah.
Or did you say for-profit?
Not-for-profit.
Yes, the not-for-profit has the same two options that for-profit entities have. You can choose to account for that as debt, or you can choose to account for that as a grant. If you take the grant accounting approach for a not-for-profit, you're going to begin recording forgiveness through your P&L when you've substantially met the conditions or they've been explicitly waived. So in this case, what we would expect for not-for-profits is that taking it as a grant would result in matching essentially the forgiveness with the expenses, as long as you are really certain that you're going to be getting that forgiveness. Anything else on that? I noticed nobody asked questions on impairment. I'm going to be glad, but it's probably because you're all asleep. It's fine. Impairment's dense. All right, guys. I have one more slide for revenue, and then I'm going to turn it over to Sara. And really, I just want to talk briefly about the impact of COVID on revenue recognition. Privately held calendar year-end companies were required to adopt the new revenue standard under Topic 606, originally on January 1st of 2019. But at the same time that the FASB provided the relief around extending leases for another year, they also gave some relief for those companies that hadn't yet issued their 2019 financial statements as it related to revenue. So they said, hey, if you have not yet issued your 2019 financial statements, we're going to give you one more year to adopt 606. And so that delayed that required date to January 1st of 2020. So in either case, the majority of the participants on this webinar are going to have adopted 606 before or during 2020, and that's what we're going to focus on discussing here. And we really just wanted to point out a few considerations. So the economic fallouts from the pandemic are going to be able, certainly have the potential to impact many considerations as you look at that 5-step revenue model that Topic 606 provides for. For example, customer collectability issues when a contract is signed could possibly indicate that maybe you don't really have a contract at all. Or if the pandemic resulted in you modifying some of your existing contracts, what's the proper way to account for those modifications? And there could definitely be impacts to the various elements of variable consideration as a result of the pandemic. If you provided any price concessions on existing contracts to your customers that may have been struggling, or perhaps your contracts provide for an early completion performance bonus. And if they do, has your ability to complete your projects early been impacted by COVID? Are you offering sales incentives to increase your sales currently? Maybe you're offering people a discount on future services. That could have implications under 606. Or if you are selling a product and for some reason, COVID has impacted your product return rates, that could also impact your sales return allowance. So you'll need to consider things like if you begin offering any extended payment terms to your customers that could potentially need to be accounted for as a financing obligation, or if maybe you need to revise any estimates you've made on your progress towards completion if you have projects where you're taking revenue over time. And then things related to revenue, the pandemic could certainly impact your estimate of bad debt expense if your customers are struggling financially and they're not able to pay their AR balances as they once did. And certainly the new cost accounting rules that are associated with customer contracts, those could be impacted. Those require you to capitalize certain costs associated with obtaining a contract or fulfilling a contract. And changes in estimates that could result from just the economic impacts of the pandemic could require you to adjust those capitalized amounts. The big picture here is really just that the application of Topic 606 to your business can certainly be somewhat complex, depending on the industry in which you operate. So if you have specific questions or concerns about how you might need to adjust revenue in 2020 for changes that you've made during COVID, just reach out to any of your contacts at Maxwell Locke Ritter, and we're happy to try to help with that. And unless there's a question on this slide, I'm going to turn it over to Sara to talk to us about inventory overhead allocation.
Okay, so this is guidance that has always been around, but we don't typically have to apply because we just don't typically have abnormal shutdowns, and abnormal would have to be really outside of what you would expect. And I think, there are always times when you are expecting shutdowns that kind of tend to come with either planned maintenance activities, or you just know it's kind of typical to have those things. But I think we can all agree that COVID is kind of one of the first times we've had a very clear-cut abnormal shutdown that was very unanticipated and unknown. And so we are having to apply this inventory guidance that we don't typically use. So variable overhead is allocated just like it always is. So to each unit produced based on your actual use of your production facilities. The fixed overhead is where it's a little bit different because it is allocated to each unit based on normal capacity of your production facilities. And you wouldn't increase your per unit allocation as a result of abnormally low production and having kind of the same fixed cost, but fewer items produced. So any unallocated fixed overhead is expensed as incurred when it's outside of its normal capacity. Your freight and handling costs are also a little bit different during these times. So if you have any abnormal freight and handling costs, you would expense those as incurred rather than allocating them to inventory. And wasted materials and spoilage, this is pretty common. People are pretty much just expensing this as incurred as well. but that doesn't get allocated to your overhead as well either. So let's talk about kind of what normal capacity versus abnormal capacity looks like, because that's how you determine what portion of your overhead cost you're going to expense versus capitalize. So your normal capacity is your range of production that's expected to be achieved over kind of a number of periods or seasons. However you look at your business, not everyone has seasonality. So just over those certain production periods, what is that normal range? And so you would look back at your historical production cycles or seasons and get a sense for what those production amounts are, and any variation outside of that range would be considered abnormal. So you are going to have expected variation production, so you would take that into account when you're coming up with this kind of normal capacity range. And you would want to look and think about, okay, now that I kind of have determined what my normal capacity looks like and what my abnormal capacity would look like and kind of what's outside of the range, looking at 2020 and looking at those periods, do you have any of those production periods that are outside of this range that you established? So if you had shutdowns in facilities, which I've had a lot of my clients go through during certain periods kind of right after this happened, and some who are still experiencing shutdowns, idle equipment, reductions due to supply chain issues, where you just had to lower your production levels because of not having raw materials coming in at the times that you needed them. So any of that, when you're kind of looking at those levels, you would think through, if you're being audited at your 12/31 year end, is any of that inventory that was produced during those periods still on hand as of year end, to where it would have an impact on your report, and it would kind of need to be looked at from your annual reporting. So that's kind of what's going to trigger you to do this analysis, is whether or not you've churned through that inventory and already expensed it. In that case, it's already out the door. And if it's still sitting on your books, then we're going to have to do a little more work. So we'll kind of go through and talk about what that looks like. So just to give you an example, you're going to calculate your fixed overhead rate per unit based on your normal capacity for each identified kind of abnormal production cycle. So you'll take your total actual fixed overhead for this particular production cycle that was probably during COVID and maybe during your second or third or fourth quarter, and divide that by the units produced under your normal capacity production cycle, probably your high end of the range, low end of the range, and get kind of a per unit cost. So if your actual fixed overhead during this kind of shutdown period was 3 million, and you produced 1 million units typically during the production cycle, that's $3 per unit. And then you're going to calculate your total fixed overhead capitalized to inventory produced during your abnormal production cycle. So you're going to take this fixed overhead rate under your normal capacity that we just calculated in that first step and multiply it by the units produced in your abnormal production cycle. So say your production dropped during this period to 500,000 instead of your normal 1 million. You'll take those 500,000 units times $3 per unit to get your 1.5 million. And that is the amount that you will capitalize of your fixed overhead. So that means of your 3 million in your actual fixed overhead, you're going to remove that 1.5 million that's capitalized to inventory, and 1.5 million that's left will just be expensed as incurred. So hopefully you kind of churned through that inventory and you don't have to look at this, but you would look at your inventory on hand at year end to see what you actually applied kind of throughout the year. And you might have to expense some costs to cost of goods sold earlier than what you were expecting. So I think, a lot of my clients, I have some that are kind of setting that overhead rate at the beginning of the year through an ERP system. So it's just churning along through the year. And so you might have to look at it at the end of the year and kind of do an overall calculation. And then some of you are just waiting, at the end of each quarter or at the end of each month and applying, kind of doing a manual calculation of overhead as an estimate and applying it that way. So in that case, it might be a little bit easier than having to look at kind of what your system applied and back that out, because you're just changing your estimates around what you're allocating to begin with. So that's really it. So unless you all have questions on overhead, I think we are all good and we have finished. Some people have asked where you can get a copy of the slides. We'll send those out to all of the attendees after. And we will also have a recording of this presentation up on our YouTube channel we'll send out that link within the next day or two. It'll come through all of our social media sites, so LinkedIn, Facebook, and wherever, so you'll be able to find that. So slides, and if you need to go back and listen to these recordings, I know it's a lot of material. We're happy to continue to answer questions if you all have questions. And for CPE credit, when you exit out, you will have a screen pop up that will give you a survey to answer questions so that you can get your CPE certificate, which will be emailed to you. And if there are any issues, we'll get that to you. So, but any kind of questions that you want to send through our Q&A function, we're happy to answer.
As of now, Sarah, there are no more questions. We're happy to stay on for a few and just see if anybody has anything. You can also reach out to any of us directly.
And we have another presentation coming up in 2 weeks. That will be 2020 year-end tax update. So that should be really interesting after the election. So we're looking forward to that. Okay, I think we're all good. I don't see any questions.
Yeah, I don't see any either.
Thank you everyone for joining us.
Thanks for joining today, guys.